Hello and welcome back to CMG Oral Space Forest lesson. This is a beginner's class, and I would suggest that if you are not a beginner class, or in fact you are not a beginner to Forex trading, I'll suggest that you don't waste your time here and then move on to the other levels, the advanced and the intermediate level. Check in our page, our playlist, and you see that. So don't waste your time here. So for the beginners, there are some terms that you need to understand, have better understanding of them in order to actually do well in this profession. Like every other profession, there are some terms. There are some key terms that you need to understand, right? So if you understand these things, then you can better use them to your advantage. So this is it. So we know which much time here. Just continue. Actually, this will be one session of the terminologies, and then the other there will be a second session, right? Now, it's not going to be sequential. I'm not going to do this and then do the other one as part one. No, I'll only do them when we get to the point that we actually need them in our practicals, right? So this is what I'm going to do. So this is basically some terms that you need to understand them. They are very basic. So as they are basic, we need to have better understanding of them. Then we do what we can actually progress here. So the first term is to go long, right? In Forex, we know there are things, there are other two things, actions that we can actually take, right? When you actually ready to trade, either you buy or you do what you sell. On the other part is to wait, right? But we are talking about taking an action, an actual action. So you either buy or you sell, right? And in this buy and sell, we have some terms which are in fact synonymous terms, right? Similar terms that we can use them. They all mean the same thing, right? So an example is what? To go long, right? If a trader asks you that I'm going long on a particular pair, right? What it means is that the person is what is buying, right? To go long is what is buying. There are times a trader may even use the term like I'm bullish on this particular pair or that. They are still in the same domain, right? So to buy it means to what? To go long. In the same way, to short, right? Look at the spelling. To short means to sell a pair or sell the market. It's as simple as that. Now, if a trader tells you that he went long on a currency pair, it means that the person actually did what? Was buying, or he bought. He or she bought. That is it. Now, while if they tell you that they short the currency, it means that they actually will sold the pair. So you get to know, you get to see that all what we are going to do, or whatever we are going to do in the forex is what is buying and selling. These are the only two terms that we're going to do, like I said, right? So just stick with me. So we are going long, right? Going long, or we are buying the market, right? If you are shorting, you are selling the market, or what you are doing. That is it. You are going down that trend. You want the market to go down, and if you are going long or you are buying, you want the market to go up. You are going to benefit from that. So that is it. Now, we have a term. I also introduced a term just a minute ago, like a bullish. The trader is bullish, right? If you are bullish, or it means you want the market to go upwards, right? If you are bearish, it means that you are actually currently wishing that the market goes down, right? So a bullish, so that brings about the bullish market and then the bearish market, right? So the bullish market, it means that the market is just going upwards. It's as simple as that. And then the bearish market, the market is what? Going downwards. It's as simple as that. Now, when someone tells you that a currency pair or commodity is bullish, it is just telling you that it is going up. While the other is what? It means that the market is what? Going down. It's as simple as that. You can take some note of this. Very, very, very basic terms. That is it. So it's as simple as that. Now, bullish, right? You want the market to go upwards, right? If you are bearish, you want the market to go downwards. That's a signal, right? That is it. Now the terms are just taken from these animals, bulls and bears, right? So there's this funny analogy that many in fact mentors or the teachers say about the bears and bulls just to make people understand it. That they say that when a bull wants to knock you down, it knocks you from and then take you up, right? It just knocks you from the bottom and then takes you up. That is what they say. And then the bears will knock you what from the top and knock you down, right? A bear will knock you down, and then a bear will knock you down, and a bull will knock you up. So that is it. It just as simple as this. And hence this image, right? So this is a bull. The market is going up. This is a bear. The market is just going down. It's as simple as that. That's what they see. Sometimes I think they have a point. Now what bulls do? The bulls, what they do? Bulls, they are actually buyers, right? So these buyers are called what? Bulls. So in the market, bulls are called the buyers, right? Because we want the market to be bullish. The bulls are buyers and then the bears are sellers, right? It's as simple as that. Now, so we have looked at the two terms, bullish market and then a bearish market. Now we are going to look at the third one, which was a ranging market. A ranging market has another term or another name called the sideways, right? It's moving sideways, or better say the market is consolidating. It's as simple as that. Now, a market is said to be ranging if it does not have any particular direction, right? The direction, we said that we have an uptrend and a downtrend. That's what you actually tell a trader to actually take an action, right? So a market could be going this way, right? Or better say, it could be just going downwards, you see. But there are times that you can't actually see or identify as a thing that this market is actually going up or down. So it's actually just what moving within a channel, such as this, right? Such as this. So when it happens this way, you don't really know if it's an upward trend or downtrend. So when this is done in a uniform way through a channel, we call that a ranging market or sideways market or whatever. So that is as simple as that. So you don't really know, you can't really determine that it is what a trendy market or yes, either upward or downward. So when it happens in this uniform sense, then you call it what a ranging market. It is as what simple as that. Now let's move to the trending market. In fact, I've even used that explanation in the ranging market, right? So the trending, there's a particular direction. It has a direction, whether upwards or downward. It's very clear. Yes, that is it. Now, so you can hear people say a market is trending upwards or the market is what? Trending downwards. It's either moving up or downwards. That's what it means, right? So we look at some graphical representation. Look at it. Now, so you may hear people tell you that the market is just ranging. They are indirectly telling you that the market has not found any direction yet, right? That is what is above there. So it has, wait, so we have done a ranging and then this is the trending. So right now, let's look at the trending one. So this is a trending. Now, a trending market is either going up or down, right? That is what it means. A trending market is either going up or going down. Now we have already looked at what are the factors or the things to actually identify if a trend is upward or downward. We have done that in the previous videos in this particular playlist. Please, if you have not done that, you might get confused. So it is advisable that you watch from the beginning. You will really appreciate this series. I am actually taking my time to do this. You will hardly see people doing videos on this particular things for the beginners, right? Many people just enter into the profession just starting from the intermediate where they are introduced to the money side, the technical analysis, and then they start doing that. Sometimes they find themselves wanting because there are some terms that they do not really understand them. So I am actually doing this into 3 sessions, right? The beginners, the intermediate, and then the advanced. I have actually done a complete series on the advanced, right? So this is the beginners that we are doing. So please, watch in our description and our page, and then like, subscribe, and then share. Right? This is a free class. You hardly see this thing done over the internet. Right? People actually teach, but they don't actually take you through this systematically. We just do random videos. I am not doing that way. So please take advantage of this and share. So back to what I was talking about, the trending one. So we have upward trend and a downward trend. Right. For upward trend, it means that the market is generally looking at it literally, right? Visually, you see that the market is actually moving down, right? Moving down, right? So we call it, we have terms that we actually use to identify them. We have H8 and then HL. It means the higher high, the higher low. I'm not going to explain this in again. Go back to the videos and check. So it means that the market is going down, up. So you know what it is. If you have actually watched from the beginning of this playlist. So this is an upward trend. What market? So that is it. Now let's look at what the downtrend. The downtrend also looks like this, right? Generally, the market is what or prices are moving downwards. It's as simple as that. You don't need to think. You don't need to be a pro, right? You don't need to be an expert to actually identify or know if the market is a downward or upward in upward trend. It's as simple as that. That is it. So we have looked at the upward trend, the downward trend, and then we are going to look at the ranging what market. Look at the ranging market, like I said, right? If you take a particular portion of the price action, right? If you open your charts and look at the price action, you can actually see a number of what trends, right? When you open a chart, right, you can actually see the different types of what the market direction that we are talking about. Now let's focus on this part, right? This is a ranging market, right? The ranging market, we said that there's no particular direction. The market moves in a particular linear channel, right? So it goes up a bit, it comes down a bit, it goes up a bit, it comes down a bit. So this is the nature of what a ranging market. That's what it means, right? It's as simple as this. Now, at times you can open the market and see different types of trend, right? Price action in the chart. So now, if you observe, look at this. We have a trend what market here, just a short one, an upward trend, a short one here, and then we have an upward trend, a short one here. You see. So when you open the market, you can actually see a number of what price action. It's just a matter of how long. Looking at your time, your the trading session, the time frame that you want to actually trade, you identify this, you decide, right? So it's as simple as that. Now, like I said, look at the name, the ranging, another consolidating, better say what? Sideways. Sorry, I think there was a wrong spelling here. Side, like you know, sideways. Now, I think there's another thing here. Sorry about that. Now, ranging market is a market where the currency per prices move back and forth between a price range of a higher price level and a lower price level. I've already explained it. This is just a reading, right? Now, the highest price level is formed with a resistance level, whereas the lowest price is formed with a support level, right? Now, traders depend on these lines to place ideal entry or exit orders in the market, right? Now, when the currency pair price touches the resistance level, traders receive a signal to exit the market due to an unexpected downtrend. When the currency pair touches the support line, traders receive a signal to enter the market due to an expected uptrend. It's as simple as that. We will look at them in the practical sense. If you move to the intermediate class, it is better explained there. So we are moving on. Now, this is a very key, this is very important term that, in fact, when I was an amateur, I really found it difficult understanding this, right? So this I have actually taken my time to explain to the various level, right? To the rudiments, to the basic level, where everyone they actually understand. You see, someone may say this is not really important for a trader. I bet you this is very important. Because if you don't understand these terms, you will find yourself wanting. Here's the case: this profession, you don't have an end to learning. We are always learning till maybe you actually quit, stop trading or something of that sort. And besides the fact of trading, I like economics. I like money. If I say I like money, it's not about the fiscal, the dollar bill or something, but I like anything about economy, right? Managing money, managing assets, managing resources. So these are the terms that you actually know. You have better grasp of them. It's very important. I really suffered, found it difficult to understand this term, right? Until I actually took my time, did some research, and understood it very well. So please bear with me, right? I've made it simple instead of reading a lot of reading and all that. I've just made it into some points, right? So you may have heard what is a hawkish and a dovish what market, or whether it's a hawkish and dovish what monetary policy, right? Let me give you an overview of what is this. Now, in economy, in fact, when I was young, I was a student at the university. We had some short course that we did on in economics, and I kept asking that why is it that many a time you hear the government saying that there is too high of an inflation and then prices are going high, there's shortage of money, and then that and that. And I'll ask myself, um, when it comes to money printing bill for money, is it not at the national level, right? So if there's no money in the system, why don't they print more? And if there's too much money in the system, why don't they maybe take it away or maybe share some? You see, I have this amateur kind of understanding. I didn't really understand it, right? Until this profession called Forex. So it means that there is some system or there's some an institution, better so some people who actually control this. So their main purpose is we call them monetary policy makers, right? They are the government level, the central bank level, right? So what they do is when there's too much money in the system, right? Someone may say, when there's too much money, then it's a good thing. But when there's too much money in the system, they have a way of bringing it to equilibrium. And when there's too less of money, they have what a way of what bringing it to equilibrium. So this is what they do. So they make sure that there's not too much of something or there's not too less of what money in the system. So basically, that is it. And they do this through the inflation, the keywords like the inflation, and then there's a way of what actually controlling, bringing this down to equilibrium. We call them what contractionary and then expansionary. These are the key terms that help them to bring this overheated economy and then less heated economy in the system. So that's what they do. Their main purpose is that just bringing things to equilibrium, right? So that there's not too much of it and then too less of it or money in the system. So this is the idea. This is from the basic level, rudiment level, right? So now we are going to look at what it is. So now, when you say hawkish environment, a hawkish economy, right? From this graph, we'll come back to this. From this picture, it means that there's currency is what? There's too much currency. There's too much money appreciation. The currency of that country is appreciating. It's on the higher level. Too much of the money, more money in the system, right? And then what it means that what? There's interest rate going up, right? There's higher interest rate in that. And then when there's too much high interest rate in the system, then the policymakers, which we call what they use a particular way, a particular strategy to actually bring this down to equilibrium. What we call what contractionary what monetary policy. They have this, they use this to actually break it down, right? And then there's what their objective of using this term is to help them what reduce or contain inflation. So we understand it now. So these are the factors, right? And that, right? So they use this policy, and with this using this, they use what their objective is to bring down inflation, to reduce it, to contain it. So that is it. It's as simple as that. You look at them further. Now, when you look at the dovish one too, dovish means there's the currency of that country or that nation is becoming weak, right? You understand? There's less demand for that. The money is small, it's very weak. is just depreciating, right? And then we have what? The interest rate, what? Which is very weak, right? Reduced, right? So when it happens this way, this monetary policies makers, what do? They bring in this term called expansionary. To expansion, just the basic word to expansion, to expand, right? So they have to pump money back into the system, right? So their objective is what do they do? Is what stimulates the economy. The economy has been weak, right? The economy has been weak. So economic growth, economic activities, those things, they are very weak in the system. So this is what it means. This is an overview, right? So we are going to look at them in depth. Now, terms to what? To note. Now, hawks and doves is a way to categorize how government officials view foreign policy. Now, those who seek an aggressive policy based on strong military power and other means are known as what? Hawks. Whereas doves seek a less aggressive foreign policy with reduced monetary policy, right? So what it means is that Hawkers wants the system to what? The economic system to be what? To be lively, more economic activities, more money, more investment, and all that. That's their aim. And then Dovish want those the overheated economy to actually calm down, right? So that is what they do. So the term hawkish and dovish is taken from this basic term hawks and then the doves, right? Now, there are two types of monetary policy, right? Now, monetary policy includes the policy set by a nation's central bank. Now, monetary policies are only set by the central bank. When you say a central bank, it's the highest bank with the power, with the mandate to make monetary policies. When you say monetary policies, as in helping the economy, if the economy is weak, they have a way of going around it. If the economy is too strong, they have a way of organizing, pumping too much money or more money into the system or reducing the money flow in the system. Basically, you are an amateur, so I'm going to keep it as simple as this. Right now, the two keywords, right? The techniques that they actually use in what controlling the economy are these: expansionary monetary policy, right? And then we have the contractionary monetary policy. Now let's look at the expansionary monetary one. Now, how does it work? It works by expanding the money supply, right? Money supply faster than usual or lowering short-term interest rates, right? It is enacted by central banks and comes out through open market operations, reserve requirements, and certain interest rates. We also look at these things, right? The market operations, reserve requirements, and then certain interest rates, right? So this is what they do. They help to what? To stimulate the economy, as in pumping, making money, the national currency strong, right? More money in the system for people to what? Start economic activity, do more investment, bring more jobs into the economy. So that's what they do. And then contraction is just the opposite, right? Just trying to put things under control. Now, this type of monetary policy that is intended, is to reduce the rate of monetary expansion, right? To fight inflation, right? A rise in inflation is considered the primary indicator of an overheated economy, right? Which can be the result of extended periods of economic growth, right? When the economy becomes too strong for a period of time, right? They have a way of calculating this, right? Within some time frame, right? That is it. Now, the policy reduces the money supply, right? Yeah, I think you are getting the picture. They reduce the money supply in the economy to prevent excessive speculation and unsustainable capital investment. So that's what they do, right? I think you are getting it. Now let us look at this key keyword, right? You realize that this term is going to run throughout this explanation. Inflation and interest rate, right? They go hand in hand. It's going to run throughout. Now, if you care to know, right, an interest rate is the amount a lender, right, someone who borrows you money. It is the amount a lender charges a borrower, right? And it's also a percentage of the principal, right? The amount loaned, right? So the interest rate on a loan is typically noted on an annual basis, right? On an annual basis, known as the what? The annual percentage rate, APR. Now, we can look at another term, another definition. Now, an interest rate can also apply to the amount earned at a bank or credit union from a savings account or certificate what deposit, CD. An annual percentage rate of APY refers to the interest earned on these deposit accounts. So interest rates can be used in two ways. So in the first definition, an interest rate is what? The rate is actually calculated in what percentage. So let's say if you borrow an amount of money from a bank or from an institution, right? They have a rate that they charge you in percentage. So let's say we are giving you this money, usually in years, calculated in years, right? So they give you this money, let's say $1,000, right? And then $1,000, it means that every 1 month they can give you a rate of every 1 month, every month you are supposed to what pay an additional amount of 1%, right? So this 1% will be like 1% of that, I think $10. So it means that every month you are going to pay $10, right? So at the end of the period, you calculate all these percentages and add it to the actual money or the principal, right? The loan money that you collected from that institution, right? So that percentage will be calculated and added to the money that you borrow. So in total, you are going to pay that money in addition to the percentage, right? So that percentage, that's it is additional to that money. You have to pay in addition. It's what is called what? The interest what? The rate is actually calculated in what? In percentage. So the rate is calculated in percentage, right? So it's as simple as that. You borrow money and then you have to pay some kind of what additional money to that money and you pay that in total. So that's another way. Now the second way is that if you save at the bank, right, we have something called treasury bill, right? So you deposit an amount of money, and then the bank will tell you that okay, now for a period of 1 year or 6 months, or let's say 3 months. I think some banks do as minimum as 3 months, right? 6 months and then 1 year. So every 3 months, they are going to give you maybe 13%, right? 13%. So this 13% will be added to your money that you deposited with them. So at the end of the period, they are going to pay you your capital, the money that you invested, and then they'll give you that percentage. Why? Because they actually what it's just the opposite of what they gave you. So this time you are giving them the money to work, right? So they'll have to pay you what? An interest. So then interest will be added to your money and then they'll pay you that total. So you see, so it can be used in different ways, right? But basically, when economics talk about interest rate, it is what the first definition is mostly what used, right? The money that you have to pay for the money you borrowed. It's as simple as this. I think this is well understood, right? Good. Now, let's look at the term very well, right? So we had an overview over the hawkish economy, and then that of what the dovish one, right? Now, there are some factors, right, to actually identify a hawkish economy with. I actually did this way, right, so that we understand. So with this criteria, you know what is a hawkish economy and then the dovish economy. It's as simple as just take this. This is a take home. Now, the national currency appreciates, and the hawkish economy, the national economy appreciates. It is appreciating. It becomes strong, right? There's more money flow in the system. I think it's even found in the point two. So high supply of the currency, more of that currency. For instance, if you are in the USA, right? So more money, more of the USA dollar will be what in the system, more money supply. There's more money, right? Now, and if there's more money, there's what higher economic growth and spending. You have money. Just imagine it is as simple as this, right? If you have more money, you spend. If you have more money, you can actually do stuff, invest, do businesses. So this is what is happening. So more money, more economic growth, more spending. There's high supply of the currency. The currency what appreciates what when it comes to international trades, right? More money, your money appreciates. And then we said that more businesses, more business activities, and then investment deals. Right, there's money, right? Unless you want to misuse the money, but we are taking it from the good point, right? So more money, more economic activities, more investment, more spending. Yes, that is it. And then this is actually a good news for investors, right? There's good news for investors, right? Because there's high what inflation. The inflation is high, right? It's as simple as inflation is high. So and then interest rates will also be high, right? So the business owners they actually enjoy this. This is good. This is a good sign for the investors, the business men. It's a good thing. So now on the other side, at the central bank level, right? Those the monetary policy makers, they see this thing to be too much of that. So they have a way of what stabilizing things, right? So they have a way of stabilizing this overheated. We call this overheated because there's too much of this. So they have to find a way to actually what bring this thing down, right? So the ways is what is to stabilize what money supply, and then right, you stabilize the economy, and then by what checking, containing what the money supply. So what did they do? They adopt the what the contractionary monetary policy, right? They will adopt the contractionary monetary policy. And then what do? They increase what? Interest rates. It means that if you go and borrow money, the interest rates attached to that will be high. It's as simple as that. It is very logic. So let's say if you go to the bank to borrow an amount of thousand dollars, and then the interest rate that you have to pay monthly is like 30%, or sometimes 40%, you wouldn't go in for that. You would think what the money is too much, right? So they have a way of controlling the money supply in the system, right? So the money will have to what be with the central bank, right? So when the money is too much, in fact the interest rate is too much for you to get a loan, you will stay away from that. So hence controlling what the flow of money supply in the system. Please pay attention to this. They will increase the interest rate. So when they increase it, what happens? We stay away from borrowing too much money. Hence, controlling what the flow of money in the system. This is very economic. If you're economic student, I think we understand it better. Better so if you're a normal student or whatever, you still have to understand, right? I just had a course, a 1 year course in economics. I'm a computer science student, right? A computer scientist for that matter. But I actually was learned it, and now I have actually polished it, have time to understand it better. So that is it. Good. Now let's have what is it? We have already read about it, but let's have a recap. Now, a contractionary monetary policy is one where the economy needs to slow down, right? I hope you are getting the picture. The economy needs to slow down or curb high inflation, right? This involves high interest rates. So that is it. So involve what it means and what it means by involves high interest rate is it means that we are increasing the interest rate on what? On borrowing. Right. So when we do that, we are putting that the money supply in the system in check to contractionary. We are contracting it, reducing it, containing it. So that is it. Now, there's some key understanding. I want you to understand what is a contractionary monetary policy, right? In fact, this is a bonus. I didn't want to add it, but my style of learning is to make sure I understand things to the barest minimum, right? To the rudiments, the basic level, so that I can even teach another person. So I'm just giving you this as a bonus thing. You don't actually need it, but it's good that you have this. So what's actually signify or denotes what a contractionary policy, or what is actually done under contractionary monetary policy, right? So we are talking about the tools for contractionary monetary policy, right? Now every monetary policy uses the same set of tools, that the main tools of monetary policy are short-term interest rates, reserve requirements, and then high open, in fact, open market operations, right? I want you to understand what is contractionary monetary policy, what is actually done, or what are the tools used in checking that. So I'll read and you understand that. Now, one, increase the short-term interest rate. Increase the short-term interest rate. Now, interest rates are the primary monetary policy tool for central banks. Now, central banks can usually take short-term loans from the central bank to meet short-term liquidity shortages. So in return for the loans, the central bank charges the short-term interest rate. Now, in order to reduce the money supply, the central bank can opt to increase the cost of short-term debt by increasing the short-term interest rate, right? So the increase in the interest rates will also affect consumers and businesses in the economy, as commercial banks will raise the interest rates they charge to their clients, right? So this is the way they are trying to control the money supply in the system. So what they do is, if you are a bank or an institution also borrow money. Let me draw your attention to that. They also borrow money. So when they go to borrow money and then the interest rate for that short term is very high, they won't go in for it. Right? The interest rate they have to pay for that loan within that short time, let's say 6 months, 1 year, and it's too much, they won't go in. It what deter them. So this thing is not only done at the consumer level, it's also done at the institutional level, right? So an institution would will be deterred to going for loan because the interest rate is too high. So that is it. Now, the point two, raise the reserve requirement. Raise the reserve requirement. Now, central banks are obliged to hold the minimum amount of reserves with the central bank, right? And the banks would vote. A rise in the required reserve amount would decrease the money supply in the economy. Now, let me use a bank for instance. Now, banks have requirements to meet in order to operate in the country. So this requirement sometimes can be too high, right? So when it's too high, it can actually deter them. There are some amount of money that they need to reserve with the bank, right? So when you look at the savings and loans and all that, they have the requirement that they need to meet. Some money that they have to have in the bank vault or with the central bank to actually operate. So when this requirement is too high, it can actually deter them. It's as simple as that. I don't want to waste much time on this. I think we are getting the picture. I just want you to have an understanding of whatever we are talking about. Now, expand the market operations, right? Expand open market operations, sell security. Now, the central bank is involved in an open market operation by selling and purchasing government issued securities, right? The central bank is involved in an open market operation by selling and purchasing government issued securities. The central bank can reduce the money circulated in the economy, one, by selling large portions of the government securities, right? By selling them, the government bonds towards investors. So that is it. So let me take it again. The central bank is involved in an open market operations by selling and purchasing what they sell and buying government issued securities. Now, the central bank can actually reduce the money circulated in the economy, right? By buying large portions of the government securities. So when they buy these large portions of it, then the rest left the investors or whatever is small. Money has been taken away, huge sums of that security has been taken away from the economy or from the system to them. So the rest left is very small. So hence they are controlling that. They are not the ones left in the system is very small, right? So I think you have the picture of that. So that is it. Now let's go to the dovish economy. These are the factors. The dovish one is just the opposite of the hawkish, right? So currency depreciates, currency becomes weak, low supply of that money. Now, low economic activities, investments, and spending, because there's no money in the system. If there's no money in the system, how do you spend money? How do you even do business? How do you invest? Right? And then hence the economy becomes what? Slow. Economic growth becomes slow, right? Now, and this is a bad sign, bad news for investors. There's no money. Where will they get the money? Right? Now, so they have a way that these monetary policy makers want to have a way of stabilizing what? The money demand in the economy, right? So what do? They adopt the expansionary monetary policy, right? We look at that shortly. And then hence what? Decreasing what? By what? Decreasing the interest rate, right? So expansionary monetary policy is needed to spur or grow the economy. When it is low, it is slow, right? Or in the what? In the recession, right? So this is done by what? Lowering the interest rate, right? So they want more money to be pumped into the system, right? The money is actually with the central banks. And if you need money from the central banks, what do? That's where you go in for the loan. So how do they make the money supplying the system on a high level? So they make what? The interest rates what? Minimum, very small, in fact manageable, so that you can the institutions or the companies and businesses can actually go in for the loan. So the interest rate is what? Cut down, it's slashed. So it will give you the what? The power. It will give the power to the what? The investors and the business, the institution towards going for more loans. This is as simple as that. I think this is the best definition or the explanation I can give you, right? So that is it. Now let's look at what is actually a federal. I think I've already explained it. So the Federal Reserve or the central bank has three expansionary monetary what? Policy methods, right? So in this particular monetary policy, that's the expansionary monetary policy. This is what actually is done under it, right? Like we look at like we looked at in the contractionary one, right? So in the expansionary one, this is what is done. The lower what? Interest rates, right? The lower interest rates so that you can borrow more money. Decreasing what? Banks reserve requirements, right? So the reserve requirements is at least they break it down, they minimize it so that it doesn't become too difficult to actually meet them. And then the government do what? They buy what? Government what? Securities, right? So they will buy from what? The from the economy, from the business and whatever businesses in the world, in the country, right? So by buying, they are giving money. Listen, by buying, they are giving money into the system. When you buy with money. So they are giving money back into the system. So that is as simple as that. I think you are getting the picture. You are appreciating this. And then expansionary monetary policy's aim is to what? Make it easier for individuals and companies to borrow and spend money. Nice one. Spend money. Actions that all stimulate what? These actions do what? They stimulate the economy. So that is it. So with the dovish interest rate, what did they do? They will hike what? The interest rate, right? They will push it up, and then these are the factors here. What you see under that: lower inflation, and then lower economic growth. In a hawkish environment, there's what? The higher economic growth, right? And then there's higher inflation, right? So what do they do to correct it? They will cut what? The interest rate. They will cut it down. So thank you very much for watching. Please like and subscribe. See you in the next episode. Bye.